What's good, everyone? Today we are going to be talking about drip investing, what it is, how it works, and one example of how you can become a millionaire using this strategy. DRIP stands for Dividend Reinvestment Plan, and it's a great way to build wealth over the long term. So what is a DRIP? Simply put, it's a method of investing in which dividends earned from a company's stock are automatically reinvested into additional shares of that same stock. Let's say you own 450 shares of AT&T stock, which pays a dividend of 27 cents per share per quarter. That means you'll receive $124.93 in dividends each quarter. With a DRIP, instead of receiving that $124.93 in cash, you would automatically reinvest it into additional shares of AT&T stock. Because of this reinvestment, next quarter you will earn more than $124.93 because you will also be paid on the additional shares you just got. Over time, those additional shares can really add up and create an insane compounding effect. Now, as you can see, I personally use Robinhood to buy dividend stocks, and if you want to take the first step towards becoming financially free by using the DRIP strategy, you can too use the Robinhood app for this. If you don't already have the app installed, I highly recommend using my referral link that will be in the description below. If you use my link, you will get a free stock and you'll be able to start investing in stocks, ETFs, options, and cryptocurrencies with zero fees. And remember, not only will you get a free stock, but you can also start to share your own referral link with your own friends, and that will earn you even more free stocks as well. Now back to the video. One example of how you can actually reach millionaire status using this method comes from the data-driven investor. Let's take a look at a portfolio consisting of 3 companies, Johnson & Johnson, PepsiCo, and Reality Income. All 3 companies are stable companies with impressive dividend payment track records and steady growth. In the portfolio, each of the 3 positions will be allocated equally, with Johnson & Johnson shareholders in the last 15 years have experienced annual returns of 8.35%. To account for inflation and taxes, let's set the annual capital appreciation for Johnson & Johnson to just 7%. As for PepsiCo and Reality Income, the average annual returns for the last 15 years are 7.25% and 9.35%. Let's be conservative and lower the projected annual capital appreciation for PepsiCo and Reality Income to 5.5% and 8%. The projected dividend compound annual growth rates for each of the companies are 5.5%, 5%, and 3.5%. In this example, we will use the 4-year average dividend yield as the starting yield for Johnson & Johnson, PepsiCo, and Reality Income, which would be 2.64% for Johnson & Johnson, 2.94% for PepsiCo, and 3.48% for Reality Income. As a 20-year-old, suppose you decide to use the dividend growth investing strategy to become a millionaire. You make an initial investment of $30,000. To maintain equal allocation, $10,000 is invested in Johnson & Johnson, PepsiCo, and Reality Income. Each year until the age of 45, you deposit $9,000 to the portfolio and invest $3,000 each in the 3 positions. All dividends will be reinvested back into the underlying equities, courtesy of the Dividend Reinvestment Plan, DRIP. Staying consistent with the annual distributions and investing plans, you attain millionaire status in the portfolio by the age of 45. The model portfolio also generates $19,201.80 in dividend income annually, which means if you stop investing into these positions completely, you will still be able to make $19,201 per year completely passively. Now, I understand 25 years might seem like a long time, but if you decide to be more aggressive and invest more on a yearly basis, you can actually get there a lot faster. Plus, honestly, this shouldn't be your only plan to become a millionaire. This should really be a less risky plan B, just in case your plan A doesn't work out, whatever that is. So, why are drips so important in investing? First of all, they allow you to harness the power of compound interest. Over time, the additional shares that you accumulate through your drip will themselves earn dividends, which can then be reinvested in even more shares. This can lead to exponential growth over time. So, in conclusion, drip investing can be an excellent way to build long-term wealth. By reinvesting your dividends automatically, you can harness the power of compound interest and stay invested in good companies over time. And with potential returns like the one we looked at today, it's no wonder that drip investing has become such a popular strategy among long-term investors.